Okay, get this. 34 ships, oil prices just falling off a cliff, and the Nifty getting ready for a massive rally. How on earth do those three things connect? It sounds completely contradictory, right? Well, let's dive in, because the story behind it is absolutely fascinating.
Everything, and I mean everything you need to understand about what's happening in the markets right now comes down to this one simple number, 34. Not 60, not 80, which is what's normal for ships passing through the Strait of Hormuz, 34. And this is during what was supposed to be a military blockade. The craziest part? The market didn't crash, it soared.
So that's the big question we're unpacking today. Why did a number that literally signals a 50% drop in traffic make global markets happy? The answer is all about expectations, geopolitics, and one critical detail that almost everyone missed at first.
To really get what happened, we have to talk about the blockade itself, or, I guess, the blockade that wasn't. This is a classic case of how reality turned out to be completely different from what the market was terrified of.
Okay, so here's the deal. When the headlines screamed, U.S. blockades Iran, the market immediately priced in a total shutdown of the Strait of Hormuz. I mean, a complete closure. That would have choked off something like 20% of the world's oil supply. Absolute panic. But that's not what happened. The blockade was super specific. It was designed only to stop ships going to or coming from Iran. It explicitly allowed everyone else to pass through. So the strait was never actually closed to global traffic.
Now, this is where that number, 34, becomes so important. You have to put it in context. Sure, it's way less than the usual 60 to 80 ships a day. But look at this. The last time Iran caused a full closure, traffic dropped to just 2 or 3 ships a day. And even the most optimistic diplomatic deal being discussed was only hoping for 15 ships a day. So when the world woke up and saw that 34 ships got through, well, that wasn't a signal of disaster. It was a massive, massive signal of relief.
And that quote just nails it. You could almost feel the collective sigh of relief from traders around the world. They looked at that number and realized the absolute worst-case scenario was off the table. The global oil supply wasn't getting strangled, and that one piece of data flipped the entire market sentiment almost in an instant.
So, how did this news from a narrow little waterway in the Middle East cause a huge global chain reaction? Well, it set off a domino effect that rippled from those shipping lanes all the way to stock prices right here in Mumbai.
The first and most immediate effect? Oil prices. With the fear of a supply shock just vanishing into thin air, all that risk premium that traders had baked in got unwound fast. Brent crude dropped about 4% to around $95, and WTI crude plunged almost 7% to $92. The big deal here is that both of them fell below that psychologically huge $100 level.
Now, for a major oil importer like India, this is probably the single best piece of news you can get. I mean, cheaper oil directly lowers our import bill, it eases inflation, it helps strengthen the rupee, it improves company profits, and it makes foreign investors way more confident about putting their money here. It's just a huge fundamental boost for Indian stocks.
And you could see all this positive sentiment reflected directly in the early indicators. The GIFT Nifty, which kind of gives us a sneak peek of how our market will open, just shot up. It was signaling that we were all set for a gap-up opening of around 250 points, just to catch up with this global relief rally. And at the same time, over in the US, the VIX, the thing they call the fear gauge, it dropped down to 18.5. When the VIX falls, it basically means the big institutional players are less worried about a major crash. That usually signals a risk-on mood, which is almost always great news for emerging markets like ours. But it's not all clear skies and smooth sailing from here. While most of the market was celebrating, there's a hidden risk in all this that the, smart money is keeping a very close eye on. And here is the twist that you're not hearing many people talk about. Yes, 34 is a relief compared to 0, but 34 is still less than half of what's normal. The situation is far from resolved, right? We're running at partial capacity, under military watch, in a region where tensions could just flare up again at any moment.
And you can see this nervousness reflected in the actual market data. Just look at this split, it's wild. Retail traders are overwhelmingly bullish. 74% of their positions are long, but the foreign institutional investors, the FIIs, are positioned in the exact opposite way. A whopping 78% of their positions are short. They are clearly hedging their bets just in case this rally turns out to be a fake-out.
Which brings us to this really key idea. Right now, the market isn't priced for the reality of the situation. It's priced for the hope of a resolution. And there's a big difference. If those diplomatic talks fall apart, or if there's another incident,
this whole rally could unwind just as quickly as it appeared.
So, to wrap it all up, here are the 3 things you really need to take away from this. First, that number 34 was all about relief, the gap between what we feared and what actually happened. Second, oil falling below $100 is the single biggest positive driver for India right now. And third, the level to watch is 24,000 on the Nifty. That's the new battleground, and how the market acts there is going to tell us a lot.
Hey, if this breakdown helped you connect all the dots on what's driving the market, do me a favor and let me know. Just drop the word Hormuz in the comments below. It really helps me know that this kind of global context is useful for you.
And of course, if this added some value to your day, please hit that like button and subscribe for more daily breakdowns on what's actually moving the Indian markets. And as always, the quick but very important reminder, I am not a CDI registered investment advisor. All of this is just for educational purposes to help you understand how these big global events connect. Please always do your own research and manage your risk. Stay sharp out there, and I'll see you in the next one.